Want to be sure you're getting the most out of your retirement for all the years of your retirement? That's the primary goal of More Living with Jim Brogan and our Dollars and Cents segment, where we provide you with an important financial tip that will help positively impact the quality of your life in retirement. And now here's Jim with this week's Dollars and Cents tip.
How do you read a Morningstar report on mutual funds, and what should you be looking for? What should you not be looking for? That's what I'm going to talk about in Dollars and Cents today. Morningstar is an independent third-party company that analyzes mutual funds. They're considered probably the industry leader in the field. By being independent, that means they don't accept money from mutual fund companies, so they're considered a third-party resource, so you can feel confident about their research. Here's the main thing I want to leave you with, without getting too detailed in a brief time in our Dollars and Cents segment here, and that is, be careful that you don't just look at any one thing from Morningstar and determine, well, I should buy that fund or I should not buy that fund. Especially the rating. You know, some people say, oh, it's a 5-star fund, I'll buy the fund. Well, remember, the rating compares that mutual fund to other mutual funds in its category, not all mutual funds in the industry. And they rate 1 to 5 stars. 1 star is, well, first off, it's a bell curve. 1 star is very poor performance. 5 star is very good performance. And it's a bell curve, meaning there's very few 1s and 5s. There's more 2s and 4s and a whole lot of 3s. Okay. I mean, you should look at the rating, but it's not the be-all, end-all. I would say the category is maybe more important. I mean, I've seen 3-star funds that I would probably recommend above 5-star funds. I still probably wouldn't recommend maybe you buy the 3-star. I may say, well, in that category, you know, that may be better than a 5-star in another category, but why not get a 4 or 5-star in the right category? So, you know, be careful. You don't just see the rating and say, okay, I'll buy that fund. It's got a 4 or 5-star rating. Okay. Be careful with that because it doesn't compare it to all funds. Also, there's no one thing on one of those Morningstar reports you can look at. But the one thing I want to bring up is the fees. We get so focused on what are the internal fees and charges in these mutual funds. Now, I'm right there with you. Obviously, if they're low fees and low costs, that's going to be more return for you, right? So as a rule, I think you should look for low cost, low fee mutual funds as a rule. However, I think you're making a mistake to say, I'll only consider low-cost funds. That, again, kind of goes back to what I was talking about a minute ago with managed mutual funds versus index funds. You're kind of boxing yourself in a corner. Why not consider everything? I mean, I do think for the most part, low-cost funds are the way to go, but I wouldn't ever want to eliminate a fund just because it's not low-cost. I mean, let's be honest here. If the last 5 years we've had a challenging stock market, you know what? Let's say the last 10 years. If you had a mutual fund where you made 12 or 13% a year that was your return for the last 10 years, would you care if the mutual fund company made 1.5 or 2? Probably not, because you probably have made 1% a year or 2% a year the last 10 years if you're in stock mutual funds. So, and maybe 5% a year if you're lucky. So again, the number one thing we want is the best after fee return. What's the net return to you as the investor? Well, why would I ever want to eliminate a fund and box myself in a corner? Now, having higher fees and costs is certainly a reason a mutual fund may begin to lag over time. And again, that means it has to be watched very, very closely and watched like a hawk. And it is your life savings. You should do that or have somebody doing that for you that's proactive. But I wouldn't want to eliminate that. I mean, I'm thinking of a fund in particular that in a 5-year period, every time I look at the performance, it's in the top 5 of its category over 5 years. That means net return to the investor. But you know what? It's pretty high cost. I mean, it's a good bit higher than the average in the industry. But the net return to you, the investor, is always in the top 5. And it's usually number 1 or number 2. So Don't box yourself in a corner. I think you're doing yourself a horrible disservice. Yes, I'm a fan of low-cost funds, but that doesn't mean you don't even consider all that. I guess the number one thing I want you to take out of today is don't limit yourself. Look at everything. Don't box yourself in the corner by saying, I only want funds that meet this category. They're either managed or they're low-cost index. I mean, whatever. Don't box yourself in a corner.